Welcome back to my channel, Wealth Builders. Today we're talking about something that trips up even the most experienced business owner. It is estimated taxes. If you are self-employed, whether you're a sole proprietor, whether you are an influencer, whether you own an LLC or an S-corp, you have to pay estimated taxes. And when you don't, my friends, you will get hit with major penalties and interest and will get on IRS's nasty gram list. So I want to make sure in this video you understand exactly what you need to do. And I am going to ask that you give me comments so that I can answer your very specific questions. What are estimated quarterly taxes? Well, I want to start with the basics. When you are a W-2 employee and you work for an employer, they withhold out of your paycheck, whether it's monthly, weekly, or bi-weekly, they withhold your federal and state income taxes if applicable. Well, estimated taxes take the place of that for business owners. Because we are in the United States a pay-as-you-go system, we have to remit as business owners our own income taxes to IRS on a quarterly basis. And it's our responsibility to make sure it gets done and to make sure it's calculated properly. When you don't pay the correct amount of estimated taxes, IRS levies its big secret weapon. The secret weapon is penalties. They will assess you with major penalties for failure to pay estimated taxes. The law requires you to pay in quarterly at least 90% of current year's tax liability or 110% of prior year's tax liability. What does that mean? If we're in tax year 2025, that means whatever I think my taxes are going to be for 2025, I have to pay 90% of it in using the quarterly dates, or I have to pay 110% of 2024's tax liability. And if you don't, they're going to assess you with 5% penalty every month up to 25%. And when you have underpayments, that 25% can be a lot of money that you don't want to have to remit to IRS. When you don't pay your estimated taxes, you literally have a cash flow killer. What is that? That means that if you go all year, don't pay those quarterly taxes, come April 15th of the following year, when you get your taxes prepared, you're going to have a tax bill due. And then guess what? Your current year's estimated taxes are also going to be due. Once you get behind, my friends, it's very difficult to catch up. That's why it's so important to pay your quarterly estimated taxes. And if you can't pay the whole amount, at least pay something. Why? So that when you get to April 15th, the bill won't be so high. When it comes to estimated taxes, it's more than just money. The IRS is scrutinizing what you do as a business owner. If you fail to pay your estimated taxes, IRS also thinks you may be trying to cheat the system. IRS keeps track of what's called a Diff score, a score of where an individual falls out of the norm by more than 3 points. That's when IRS will flag your return for audit. So if you're not paying your estimates and you're paying late and you're filing your taxes late, that's going to give you a Diff score and flag your return for audit. I don't know too many people that want to be up close and personal with IRS, so you want to make sure you stay on top of those quarterlies. Not paying your estimated taxes can affect your business credit and your business reputation. Because if you get behind on your taxes, IRS can file a federal tax lien. Therefore, when you get ready to go apply for credit, and they run your credit report, it will show on your credit report that you have a federal tax lien. And the only thing that supersedes a federal tax lien is back child support. Other than that, if you're trying to secure money, that money you were going to get from that creditor is going to go directly to IRS. So you do not want to put yourself in that position, hurting your business because you wind up with the federal tax lien. What can you do to avoid the trap? You want to make sure you understand when your quarterly taxes are due. They are due April 15th, June 15th, September 15th, and January 15th of the following year. Yes, you can pay 110% of prior year tax. However, that may not be the correct amount of tax to pay. It is going to prevent you from having a penalty. Absolutely, it will, but it's not going to necessarily solve your problem. My advice to you is always get a calculation of how much you're going to owe and estimated taxes for the year. Therefore, you know exactly what number you need to shoot for, and you can increase or reduce your quarterlies accordingly. Underpaying your estimated taxes in the beginning may seem like a little harmless situation, but as it compounds, it will literally become the killer of your business because you will get yourself on this endless treadmill where you can never catch up. Don't put yourself in that situation. Make sure you plan not only for your business expenses, but also for the expense of having your taxes. Get your business started the right way from the very beginning. And if you're not on the right track, get yourself back on the right track. That is how businesses flourish, by doing the right thing from the very beginning. And now that you know better, you absolutely have to do better, my friends. I want to make sure that you are paying your quarterly estimates using Form 1040-ES and your applicable state form. And now that you're doing that, I'm also going to ask you to leave some comments, and subscribe so I can make sure that I am answering your unique questions.